And if you want to go all in real estate, you got to realize it's not quick money. It's most of the investors I get on with. Yeah, we listened to your stuff. We heard you on 20 different podcasts.
What does investing in a luxury self-storage look like?
You listen to guys like Alex Hormozy or you always find that I don't want to just sell a watch that's $100. I want to sell the $4,000 watches that like gain value. So I added luxury to a simple storage business, offered more of a premier product.
I'm your host, Pascal Wagner, and today we're joined by Marc Kuhn, founder of Mac Construction, Mac Capital, and CK Agency. Marc has built 3 successful businesses generating 8 figures annually and has redefined what's possible in real estate with his focus on luxury self-storage. If you're curious about how this asset class works, why it thrives in certain markets, and what LPs need to know before investing, this episode will be packed with valuable insights. And with that, let's dive in. Welcome, Marc.
Hey, thanks, Pascal. Thank you for having me on, man. This is awesome.
Yeah, I'm excited to dive in here. A lot of stuff I want to cover here at the beginning, but I wanted to first let's start out with what we've been talking a little bit about. You've been on social media a lot the last several years, and really maybe even 4 years, and it's been taken off. And you said last year you did over 150 podcasts, and sometimes it's kind of a lot all at once, and it wanes and comes back. Would love for you to kind of talk about what it's like as an operator in North Dakota, of all places, to really get on social media, and what has that done for your business? How, LPs coming to you, maybe in misconceptions people have about you. Would love to start there.
Yeah. So a guy that drives a Tesla in North Dakota is not common to be on social media. I think I had 300 followers maybe total in November of 2022. That's where I started to you could see a lot of social brands getting built in COVID. I wish I would have done the same because it was much easier to buy attention at that point. But, there's never a best time to start anything. It's always yesterday anyway. So, I took the deep dive November 2022, had hardly any following, and I don't think you go for a following, right? Like you're going to try to help people. I think if you go in with that mentality of like, that's the whole reason I created Mac Capital, was to help people understand real estate, how to invest passively in real estate, and why you would actually even want to put it in a portfolio and diversify outside of, the stock market. But yeah, Ryan Pineda was a mentor of mine. Grant Cardone was actually my first mentor in 2019. And it was obviously a shark on social media, created a lot of attention for himself, created a lot of following, can raise a lot of money from that, and can almost do anything, right? The brand is worth something. It's a personal brand. And then I kind of leaned over into Ryan Pineda. He was more my age, more kind of doing different things within social media, but very much a master of marketing. And then I just realized, I was like, man, I gotta lean in here and see if I can shoot 30 reels a week. And we had a really big output. I was doing 150 posts per week, reels, posts, LinkedIn, Instagram, TikTok, Facebook, Threads, LinkedIn, Twitter, X now, so that's a lot to build up to that. And, but how it has helped my companies now is like, most people can't find deals. So I just post, I need to find deals, or I need to create awareness for luxury storage. I can create all tons of awareness because everyone's like, what is luxury storage, right? It's kind of a question mark afterwards. And now I know how to do podcasts better. I know what catches attention, how to deliver a reel in a punchline format. So it's made me a better speaker. It's created more awareness for my businesses. It's created I think the biggest thing that you will get from branding is Google my name and Google luxury storage. Just Google Marc Kuhn or Google luxury storage. You will see that these social media tools are like the SEO, the search engine optimization, is incredible. It does all the work for me. And you can go and Google your name and maybe it's some other guy or gal, right? And you didn't. And mine was the same way in 2022. It took till really late 2023 for all that to change, and YouTube changes the algorithm. Obviously it's owned by Google, but man, the amount of credibility when you Google luxury storage or Marc Kuhn and you're doing a podcast with Ryan Pineda or Brandon Turner, or maybe there's an article they've written about you because people know that you have a following for a certain niche, and they're promoting that. It's such a powerful tool. Even if you don't create much of I have 3,200 followers on Instagram. It's not a big deal, but they're 3,200 really good followers. They know what I'm doing. They follow me day to day. They like what I'm doing. I have almost 50,000 on LinkedIn. It's still, they know me day to day. They know what I'm doing. Most people only have less than 500 followers on LinkedIn. So I'm on their page every day because I'm posting every day. So it's just the amount of, it's all about getting out there and being known by somebody, and creates a ton of credibility for all my companies.
I think it's an interesting discussion about like operators building brands on social media, because there are many people in this industry that I respect that raise capital that actually maybe have more of a disdain or more of a knock on those who do have social followings and brands that they've put work into, like yourself, right?
Mm-hmm.
And I think their jab when they're talking to LPs is, hey, we might not have a big social media presence and a following. We're very much just focused on the deals.
Mm-hmm.
And so I'd love for you to maybe talk to and debunk this idea that even if you've put in the work to be big online doesn't mean that you're doing bad deals or that you're any less sophisticated than those who don't choose to build brands.
Yeah. I see a personal brand. That's a business, right? That's another business. If you want a side hustle, create a personal brand. And most of these operators, they're more, we'll say they lean heavier toward analytical guys, right? I would say I would probably lean a little bit more to the risk taker, willing to do the deal. I have really good people behind me who are great with spreadsheets. I'm not your spreadsheet guy. So anyway, I'm just saying that I have a little more risk variability. And it's funny because I'm actually talked to many different operators, and they always call me about this because they have troubles raising money because not enough people know them. It's local people that know them. And it's like, well, they're not funding right now. It's like, well, your options are limited to Kansas City. It's like Kansas City dried up. Okay. Well, I'm funding from Pittsburgh, Texas, Florida. They're sending money up to the Midwest because they can't find cash flow in the Sunbelt market. And then all my Midwest, North Dakota, South Dakota, Minnesota, Kansas, the Midwest is sending money down to Florida and Texas. There's always a greener side somewhere else in their minds, right? Whether it's right or wrong. But it creates so many more leverage points. And then the credibility is awesome. Like most of the investors I get on with, even yourself, you're able to know me. You probably knew my hobbies. You probably knew what I was about. You probably know what I like talking about before you even talk to me. So it's such a different conversation with LPs that like, yeah, we listened to your stuff. We heard you on 20 different podcasts. So it's like, you definitely aren't just fly by night. There's great operators that are behind the doors and maybe have really high net worth guys behind it, and they want to keep quiet and they don't want to do a whole lot. But I haven't found that to be the best. And most of those people are having a harder time raising money because it's one or two avenues. I like keeping multiple doors open, and I like educating people. That's probably why I like doing content. I think the more you give, the more you'll get in return over the long run. It doesn't pay me much. No, I make like $18 on YouTube every month. So no, I'm not retiring on the personal brand. Where the analytical person, if they spend, I'm spending about $10,000 a month on just personal brand. That's money outflow always. The analytical person's going to say, I don't agree with accountants because they don't like marketing because they need to see like what's cost per click and what's, it's not building a brand. You're not getting that kind of return. It's a slower investment. It's like investing in a 401, or real estate, whatever. It's a slow return over time. In November of 2022, I had hardly anything after a year after paying out 60 to 80 grand to buy camera equipment, all this crap. And I was like, there was times I was like, this is hard. And I don't want to shoot 30 reels this week, or I don't want to write posts or talk about or shoot selfies. And it's another job. But I think the credibility that you will earn from it as a JP and helping educating others, teaching LPs a lot what your podcast is about. My LPs come in and know the things that I'm going to tell them and try to, I have a series of questions that I ask for them. Here's the things you need to ask for me because I'll realize that they don't know what they're talking about. And I'll say, hey, go watch this YouTube video. I've already shot it. This is what you should be asking me. This is what matters. And this is what should matter to you. So anyway, I just think a lot of that just really helps. I mean, it does. And so I'd say if you're not doing it, you should be doing it. You're only hurting yourself. Is it a job? It's for sure a job. And can you look at all sorts of deals? I think anyone on your team, especially the CEO, should be shooting some kind of content, because I don't really care about Tesla, the brand, and their marketing schemes. I care about Elon Musk and what he's focused on and doing. And you'll find that in every single company. That's really what matters.
Yeah. Yeah. People follow people, not companies.
Yeah. Yeah.
Okay, cool. No, I'd love that take. I'd love to dive into, the whole reason we are here today is to learn about luxury self-storage.
Yeah.
And for those who are unfamiliar, could you give us a breakdown and how long you've been doing it?
Yeah. So I've been doing it since 2019 is basically when I started on it. I told you my mentor was Grant Cardone. Again, if you know of him, he's a multifamily guy. You always need a place to live. So that's where I really started my career, is doing a lot more multifamily, because it was hard to fight that series of that quote, it's like.
And when you say mentor, you like, are you texting? Are you like taking a course from him, coaching? What does that look like?
Yeah. So basically with him, his attention was hard to buy. 2019 was a little easier, and then COVID happened, and all of a sudden he was really going hard. I was 6 to 8 months. I was in a approved room. You had to make so much and you had to do, but you flew down to Miami, got to meet with him. It was in a group setting, and then he would meet with you for whatever and talk about your situation. He'd give you really good feedback. I mean, and it's a lot of the things I talk about today. I mean, he was not wrong. He's not a dumb guy. He understands negotiating. He understands how to build a brand and how powerful it is, because that's literally what's created him. But he also, I think for him, it's like, you're never too late. He didn't start till he's 51, really doing the branding thing. The guy's 67 today and goes harder than anyone I know, right? Like, so it was just motivating, I think, that way. He's a very motivational guy, very hard. And it took me to learn Grant Cardone. Not everyone's going to like him, but he did push hard. And I think if anyone's going to go down this route of syndicating or real estate, it's lumpy cash. If you're a syndicator, if you're a GP, GPs aren't making all that much. And if you want to go all in real estate, you got to realize it's not quick money. That's not what you're in as a GP. We get paid at the end. These are coming in 5-year increments. Understand to get your income somewhere else. What Grant Cardone does, he's got all his coaching businesses, and other avenues. And then he has these syndications that he is able to raise money and raise awareness. Are that the highest returns? No, it's not. But he gained their trust that he's buying institutional quality deals, that even if the returns are lower, you're getting returns, and he's essentially still giving what they wanted, and they trust him. But he makes a lot of money and he buys a lot of real estate. I mean, that's his path. And so just learning from him, and then I developed learning real estate, meaning self-storage, luxury storage, starting getting into that in 2019, leaning a little heavier that way, just because I had some success with it locally. And started becoming a better syndicator. Found out, when they tell you, riches are in the niches, it's very true. And it's hard to find niches in real estate, because there's all these different, I should say there's not that many different niches in real estate, right? You can make money wholesaling, BRRRR method, you do all these flips and all these different methods I've learned, and found out that I enjoy raising money. I enjoy talking to LPs. And I really enjoy the boring. I'm a concrete guy down deep. 8 years ago, I was doing concrete work. So I always like to tell people that, because I'm not like, the most brilliant scientific guy. I'm 12 credits short of a 4-year degree. I'm an ordinary person. I will qualify myself as, right? Like if I can do it, you can do it. And so the motivation for you is like, I found a simple thing, storage. I heard it does well in recessions. It does well in good times, and it's very stable. Okay. Well, that sounds nice. And it's very boring. The tenants, don't live there. They just store stuff there, and they move on. And then, you listen to guys like Alex Hormozy, or some of these influencers, you always find that I don't want to just sell a watch that's $100. I want to sell the $4,000 watches that like gain value and like it's a different customer line. So I added luxury to a simple storage business, offered more of a premier product with heat and electricity, whatever, and rent them out monthly at a higher value than, 89 bucks a month for a 10 by 20, and realized that my tenant base was better. My turnover was lower. I don't have to be an auctioneer. It's a very boring business, but it's a little bit higher end. Now, is it a lot different than normal self-storage? Not really. You just got to keep these are institutional quality products. But building institutional quality products also brings you better buyers. Now you're selling to private equities. Now you're selling to, your family offices. They're paying a premium for assets like these because they can manage it, an entire portfolio of 1 million square feet with a couple guys. And so that's where I landed in luxury storage and just kind of evolved. Some people call it flex space. I term it storage because I'm still 30-day rentals on most of our product types, which is a little bit different than the market on a 1 to 2 year lease or something like that. So, and really how I just kept going with this, I just really, you start looking at market data and, we got really into data is being, small businesses exploded after COVID. There was about 3.5 million businesses in 2016 through 2019. And then COVID happened. All of a sudden, small businesses went to almost, I think we're up to 6 million, new businesses formed, almost doubled. So all these small businesses need these flex spaces to put their small overhead in. They got to get out of their garage at some point, whether you're selling, you're running a Turo business or you're running, renting cars, or if you're a small Amazon e-commerce type business, or all these small businesses. I have many contractors, of course, and all these different things. So our spaces are cheap. They can put it on their Amex. They can expand. If they need another unit, they rent the next unit. If they don't need it that next month, then they can go back, right? So it's very expandable and less full commitment in our products. So that's really the whole backline of why I hit luxury storage. And now it's something I don't see myself not talking about for at least a couple decades.
Yeah. And like the type of tenant, like how is the tenant different than maybe the person that's just moving out of their home and needs to, in a 12 by 12 foot space? So you mentioned heating, you mentioned, what does that tenant look like?
Yeah. Well, I'll just tell you, our tenant base is 75% small business. You will have I think what you have a little bit of is you got car guys, right? Those guys are out there and they got lifts in there, but you got small businesses that rent it for their boat and their camper, but we're not an RV rental space. I think those places have to be built as cheap as possible. And they're there to store your camper, your boat, which most people have a payment on, you know what I mean? And they don't. Most of the stuff that I see, if they're storing their cars or if it's a Lambo or whatever it is, a high-end car, and these cars are paid for and they want a really nice place to put it. And we're more leaning to that. But what we are not is we're not condos. Like we're not we don't have lofts and fridges and stoves. We're more boring on the aspect of it's a flat concrete space with a tall ceiling and a 12 by 14 overhead powered door. And it's got a couple lights and outlet and climate control, so it's not as high end. Do we involve condos in some of our scenarios? Yeah, if we have to, you know what I mean? But luxury storage is very much a boring asset class. That's just, we'll say, more exciting than just a self-storage 10 by 20 container type method.
Yeah. And you're all in North Dakota. How many units have you done? Have you like mostly built all the units? Have you converted units? What does that look like?
Yeah, so we've looked at the conversion process. It's just not the feel that we want when you come into our facilities. So we have 2 facilities in North Dakota, 2 facilities, one that's getting built, one that's coming in South Dakota. And we're in Iowa with another facility. We're getting 2 more added this fall in Texas. 2 more facilities, so outside of Fort Worth. We got a facility that's real close in Southwest Florida. And it works about everywhere your businesses live, right? Like we're not on the prime time corner of Dallas, Fort Worth. We can't afford $40 a square, 50, 80, whatever that land goes for. We got to be all in one level. But so we're near these high-end bedroom communities around where land's a little bit cheaper. Maybe we need exposure to an interstate for marketing purposes and lease up. It's got to be easily accessible. But that's kind of the areas in the suburbs is where we live. And that's honestly, where most small businesses live is not in the main city. They live in the suburbs and everyone travels to the city. So we try to think about that when we're placing all of our facilities. And sometimes even tight HOAs, sometimes you can't park these people have $2 million homes and they can't even park a car in the driveway for more than a day, right? So it's like they need a place for the boats. They do need a place for extra cars. They need a place for anything. And you can be in a $2 million neighborhood and reach out with both arms and touch each house. That's just real estate is crazy right now. And you can be in a high end community and it's just not, you don't have any space and you can't park anywhere in the garage.
Yeah. Yeah. What is, thinking and putting the LP hat on, what
Yeah.
is investing in a luxury self-storage look like? Is it like someone invests with you and it's a 5-year hold and you expect 5% cash flow and like walk us through the intricacies of the deal, and then I'd love to dive more into specifics.
Yeah, let's do it. So on the most general term, if I'm an LP, or if you're an LP and you're talking to me, we try to always keep our yield on cost because we're developers, right? That's what we build out. We try to keep our development with at least a 1% spread to the market, meaning we'll build at a 7, sell at a 6, something in that range. That's what our spreads. There's some minimums that we have to have. And usually to an LP, they're like, I don't know what that means. And if they're going to invest with me, so I go more simple, you can get in the terms of IRR, and all the spreadsheet nerds listening to this can adjust that IRR to 20x plus. What do you want to see, right? Like they'll just adjust a couple quick numbers and move on. I basically will not let any investor invest with me unless I'm confident that I can basically double their money in 5 years. That's my goal from development. So since we're development, any LP listening to this, there's no cash flow during your building and stabilization. And stabilization can sometimes take some time again, we're building institutional assets. That means they're bigger. They can't be just 1,000 square foot buildings sitting out in the country. You got to build, minimum 40 up to 140,000 square feet are most of our facilities, and just say average 100 to 150 is what we try to build. And with that being said, it's like, it takes time. If it's 6 months usually to build it, these can get built pretty fast. They're a pretty simple structure for the most part, but it does take up to 18 months to fill them. So do I ask most people, if you're looking for 8% return, I'm like, well, go just invest in a debt fund. So if we do debt on our mezzanine debt or something, well, if you want your 8% return, I said, you're going to be pretty upset with you once you realize what an 8% return is on 5 years. It's only 40%. You left 60% on the table and you got no tax benefits as an investor, which should be your biggest priority. So, our cash and cash, just with rates right now, no family. I always like to tell the LP, it's like, I talk to family offices, I talk to private equities. They never care what the cash on cash is. Not that I've ever seen. All they care is, what is that multiple at the end of the deal? Is it am I going to 2x my money in 5 years? Or am I going to 2.5x my money? What is that return look like? And if you're an LP, you should be paying more attention to that than worrying about a 11 IRR or a 19 IRR. Or I only invest if it's a 16 or plus. It's like, I already know you don't know, really what you're talking about, but like, let's talk about what really matters to us in this deal. If I can 2x your money in 5 years and give you a bunch of tax benefits, do you really care that I send you $4 or $5 grand a year for cash flow?
Well, I think it depends on the investor and what their needs are, right? It's not
Correct.
that you're a bad investor or you're looking for the wrong thing. I think it's more of like, if you're a 60-year-old senior, your product isn't good for them.
Correct. Yeah. If you don't want to, if this is diversification, some of our investors are 70. I have an investor that's 89. It's like, he's just rolling it up into a trust. At the end of the day, he's just trying to maximize his ROI. He can figure that he can save some tax benefits, which is always the case at an 89-year-old method, and he can double his money or whatever it is. He still feels pretty good with it, even if he passes away and it goes to his kids. I mean, anyone can feel good about that kind of return on your money.
Yeah. Okay. So this is a ground up development play. That's the only way that people can invest with you, at least with you. And that's how you're you're putting it together. So, hey, we're going to hold on to the asset for 5 years, 3 years. Do you think about that? And I'd love to dive. Yeah. Do you think about that?
Yeah, I absolutely. And like I said, I came to luxury storage by backing into it. I learned that I wanted to be luxury, higher end, and I wanted that kind of clientele. Well, what I did is because I do have a social brand or a brand, I get on phone with really smart people that are a lot smarter than the concrete guy 8 years ago. That was me. But I'm curious. I want to say, hey, what would you buy? That's literally how we back into building a facility. It's like, okay, talk to family offices. This is what they want. And we backed into exactly what they wanted to get built. And that's kind of where we start with that, And I think if you do that in anything you do, you're always going to have a better outcome. Now I have buyers. I have lists of buyers already for the facility. So yeah, I don't know if that answers the question, but I mean, that's literally how I reverse engineer everything I do.
Yeah, I love that. I'd love to maybe, one of the things I like this train of thought where you're saying, hey, I'm working backwards. I'd love for an LP to get into the mind of how you think about acquiring assets and maybe looking at your buy box. So, hey, I only invest, within good school districts or, would be the equivalent in multifamily. I have to make at least 40,000 square feet. It needs to be by a major highway. What is that list of criteria, and how has that changed as you've gotten more experience? What have you added to it?
Yeah. Well, I think you'll talk to enough banks and you'll talk to appraisers, of course, as you finance these deals. You're going to learn that they'll talk in the terms of feasibility studies and different things that basically qualify your project for that area, gives the bank some security. So I ordered one of those feasibility studies and ordered plenty of appraisals in my life, whether it's acquiring a property or building a new one. And you just look at the data that they're looking at, because that's really what the banks are qualifying to, right? And so now we do them internally. So now we know, okay, we do look at the self-storage industry in the markets. We use a program called Radius Plus. If you don't have it and you're doing self-storage, you should definitely get it. And it definitely gives you all your demographics in the area, but it's per cap, how many square feet per capita. So that'll just generally show what the self-storage industry, and it'll say climate controlled, non-climate controlled, and it breaks it down. It shows you new permits coming up. So that'll really give you, they used to say 6 is we need to build here. And 6 square feet per capita used to be, now it's like 8, because all these renters, we're starting to turn into this renter nation a little more every day because of high interest rates and no inventory. That's only going to get worse. People aren't building right now. And so now 10's the new number, right? So like, it seems like as with all these renters, that's why the self-storage industry exists and why it keeps getting demand. So that's a big one, per square foot, per capita. And usually when you look at the climate control side, it's a lot less. You're going to look, and sometimes it's 1-to-1, 2 square feet per capita. Again, a little more premium. That's where we live. And we really try to, not all our customer base is in there, but it does show us the climate controlled luxury storage model that we have. And it shows that, there's always a bigger demand there than people think. So, and then we go through the typical demographics. It shouldn't take more than 2 right turns to get into the facility off an interstate. That's kind of a big one for some guys who buy self-storage. I didn't know that. I talked to a family office. It was like, no more than 2 right-hand turns. It's like, okay, that seems weird, but it's true. And, anytime you're thinking about why do you pick your favorite gas station to go fill up at, or why, why do you go do something and you do it all the time? Is it because it's probably more convenient typically? So you just start picking up on that. Like I even look how to get into any kind of facility. How do you get into a hotel? How do you get into, why would you go to that one, not this one? I always play, just kind of understand why do you watch one reel over another reel? I always think about things in that way now. And so as an operator, you just kind of develop that. And so I'm just trying to go through some of the non-generic stuff that they tell you. And this is more like how you should be thinking as an operator and become better at it. So, but again, we do look at like household income. And then there's some areas that like, if the household income's under 100,000, it may not bring a product type like ours. But it's not always true because there may be a lot of businesses that thrive there because it's cheaper to survive there. And it might be cheaper to build there. The land might be cheaper. So it's really hard for us. We have to navigate a bunch of demographics, vet the land, vet the demand a little bit on climate control storage. If we see other spaces that are climate controlled, we definitely look at their rent roll. We'll definitely look at, what the rent they're charging, how, what is their occupied status. So simple things like that. We do a lot of research within that. But yeah, it's amazing when a Radius Plus will break down median household incomes. It'll bring your population density, your future density, your 5-year population growth. Because you don't want to go to a market where, and again, I built in a Grand Forks, the worst demographic that you could have built in, I built in my first facility and it worked. Okay. So I am not the guy to say data proves everything. I'm just saying that it can help, right? And I know our product type works because we built it in the worst possible place you could have built it. It's not on an interstate. It's in a poor demographic area. The market's not growing. The facility is 100% full with a wait list. But there's a lot of small businesses that survive here and they need something economically to land because they can't afford the contractor shops. They need maybe more of a flex space. So you just start learning some of those things. And it's nice because we keep building these facilities. Well, we just keep getting new data on what makes a better facility better. And I don't think when you're in a niche space that we're in, it's like you need to figure out your own data, use your own data. That's why property managers and asset managers are, if you're doing multifamily, they know all the data, right? They know more than you do. They're willing to overpay for the facility because they know something that you don't know. And that's really what we're creating with luxury storage. We're getting all the data now. So we know we can pay for a lot because a little bit more because we know we can build a facility that cash flows there. And then it'd be a good product type to add to our portfolio. So hopefully that helps a little bit.
Yeah, no, that's incredible. You keep mentioning flex space, that there's this asset type is maybe between what normal self-storage and flex space. Can you talk about this flex space as an asset class in relation to this?
Flex space can be classified as luxury storage. Really what you have in flex space, you have condos. So condos would be those nice car garage condos that you see built. It could be in Scottsdale. It could be in Naples, Florida. It could be any higher end market that, Dallas has plenty of them. You build them and you sell them off. It's like a spec deal, if whatever, you can just sell some off individually. Well, my plan is always, I'm a build and hold, at least for 5 years, maximize my ROI and move on. And so that's really your condo. That's the highest end version of what we do. It's also the highest risk because you cannot rent out those type of products for the price it costs you to build them. So there's risk. If the market turns and suddenly you have no buyers, you're kind of left holding the bag and you can't make it cash flow. So also the highest risk. And then you kind of move down to more of a contractor shop, which we'll call a business suite. Maybe it's just more of a rental type facility, a little less amenities, not as high end, right? And you don't sell them, you build them to rent them. So you're just kind of like the condo shop, but you're building them more to rent them and hold them and cash flow. And then you have the stripped down version, which is literally luxury storage, where there is no floor drain, there is no bathroom in the thing. It's lighted, climate controlled, power overhead door, 16-foot tall ceilings, that type of thing. So it's everything you need, nothing you don't. And then you go into non-climate controlled larger storage. It still can be part of luxury storage and a facility. And then you can even go to parking because with all of these different things, some people just need general parking. And maybe you're in a condo shop. And so what I want to get to is there's really 4 different classes there, right? You can go non-climate controlled all the way to the condo shop. Some people, and we like to do this, is mix them on a facility because it might be the highest and best use of the land. And maybe you have exposure to a really top end road and that land was worth like $12 a foot and that just doesn't qualify for your deal. Well, then behind that, you can maybe do some luxury storage and then maybe some climate control and then even parking. And so you can kind of create a dynamic type project, which is what ours end up turning into. I mean, you don't want to just overbuild on one product type. You can have multiple product types, but that's what the flex space really is. You can add all of those different things. It's flexible, right? I could have a condo shop and I could rent 5 spots. I could actually rent a luxury storage spot and own one of the condo shops. Okay, it's flexible. Maybe I need to rent 3 luxury storage shops, have the condo shop, and I need 10 spots of parking, whatever. It's super flexible for any small business. It's just adaptable. That's why people like it. And they're not, you don't have to commit to anything but a 30-day lease. So you can flex and move all those space. So when you're thinking flex space, that's what you're thinking about. It's very moldable, very shapeable. You can shape it to any business, contractor, whoever, and serve those needs. I've never built a facility with all of that, but I'm working on one now. And it's very interesting. You could see the popularity of it and why it's becoming so popular US wide and why I talk about it a lot.
You mentioned that so you can go look up in Warren Buffett's letters dating back to, I think, 5 or 10 years ago, where he starts, maybe 5 years ago, where he talks about the United States moving towards being a renter nation. And I think, like you mentioned, with interest rates being high and inflation, that is a trend that is only getting exacerbated as it continues.
Mm-hmm.
And I'd love to get Marc Kuhn's prediction, his snow glass ball of how do you see that part of the market influencing self-storage in general as an asset class, and then also related to luxury?
Yeah. So I think as we're going to continue moving. I am a contractor. I promise you, to find affordable housing is almost impossible in this country. And if you were to ask me and you're 22 listening to this, or, we'll just say coming out of college, and you're in your mid 20s, whatever, and it's going to be pretty impossible unless you borrow money from your parents to go and buy a house and make it feasible with student loan debt. It's going to be impossible. And I'm a contractor and literally try to figure out how can you build cheaper, right? 3D printing, all these different methods. I mean, building modular. I mean, it's just all gets smaller at the end of the day and more compact. I don't know if you can really call even some of these places houses. They're campers with small foundations. And so what you're finding out is that it's just not going to be feasible to buy anymore. It's really going to turn into a renter nation. It's going to get worse. These Class A multifamily deals, how do you beat it? It's the same. It's actually cheaper to buy, and you have every amenity you could ever want. I would sell my house and go move into one of these if I didn't have 3 kids with me. It's like my kids would probably actually want to live in one of these facilities over that. And your house is going to what? Maybe double in value every 10 years. That is not where your net worth is ever going to grow. I think more and more people like me, it's like, I wouldn't buy a house. I would invest all my money. I would save as much as I can, make my cost of living as cheap as possible, and invest it. I promise you, you will quadruple whatever someone goes out and overbuys for a house and tries to create any net worth that way. Because typically your primary residence is never going to be considered net worth anyway. So that would be my recommendation. But anyway, to get back to the question, it's like housing is only going to get harder and harder. It's harder for us to. I'm so interested how Doge or, Trump administration's going to tackle this one. I've been waiting every day. I know they're not that deep into their services, but they're really slimming down the government. I'm really interested when they get to that point, what they're going to do. Because other than lowering interest rates, I don't know how you make that affordable, especially including tariffs for like lumber from Canada. And, everything's going to get more expensive even to build. And so if you reflect it all to storage and how it creates, storage centers have turned out like car washes and gas stations. I mean, they're on every corner now. These, some are really nice looking 4-story, 5-story buildings that you pull in with a U-Haul and it has an elevator right to your unit and everything's Bluetooth and it's very easy. These facilities have popped up everywhere. In a lot of institutions, high net worth guys own these facilities, develop them just like gas stations and car washes. And I don't want to compete with those people. And that's why I don't and why I leaned into luxury storage. But I think no one wants to work for anyone these days, being an employee. They want their own time, even if you're leaving an 8 to 5 and working 5 to 8, or whatever it is. Now it's like, I see more new businesses getting formed all the time. It's like everyone wants to go on their own. It's all these small little niche businesses. Even for my company, it's like, I don't have accountants. I fractionally CFO them. Some of my project managers, I just have a consulting agreement with them. Like everyone's working on their own now. And that's just becoming the norm. And with that being said, you're going to have more and more flex space need. Whether it's flex office, flex warehouse, flex whatever, it's going to be a bigger need in the future. And so I just don't see where this asset stops, especially with new businesses approaching 6 million new businesses every year in the US.
What are the biggest variables that are in play that affect your business the most? I could imagine it's anything from property taxes, insurance, cost of, I'm trying to think of like unexpected expense changes.
Yeah. Yeah. Well, the nice part about luxury storage, and I think with any asset type that runs the gray line, I mean, our storage places are a lot nicer than typical storage, but we get to classify them as storage. So insurance is actually a little cheaper. Your property taxes stay a little bit lower in the storage versus like moving to like a business suite or a condo shop. So we ride the gray line pretty hard there. And so that keeps us a little more in check. But yeah, I mean, everyone's worried about insurance. I mean, insurance is just, it's always going to go up. I mean, I don't see, everything's adjusting. These property taxes are adjusting to this new COVID era where everything's 30% more and it's not coming back down. It's just not. It might come back. It's been settling for a few years, so it's starting to become normal and it's going to keep going up. So I don't know. Some of our variable costs stay pretty tight. Storage, it's all about property tax. That's our biggest expense always. I think I need to be better at negotiating, when they do the valuations of it, um, and try to negotiate that down because you don't want some of these administrators in these counties that we work in US wide. I mean, it's not a very vigilant process of what they do. It's just, you can call them and they won't know what your taxes are. And so when we're developing these new facilities, being a lot more involved with that process has helped cut our expenses probably 20-30% versus just letting it go and let them go figure it out. We've even got our taxes pushed back a year where they'll only value the land for 1 year before, because they know you're not stabilized yet. So they'll give you some breaks up front, which is huge when you're stabilizing or getting a new property, and then being a little nicer to you on the back end when they actually do evaluate where your property is. I thought it was more of a black and white process, but as I've learned, it's not really completely that.
When you're like, let's say you're an LP kind of looking at this deal, I'm always optimizing for what is the downside. I should always be asking, how can this deal go sideways? And in your instance, I imagine it's maybe, if demand for the product shifts, or, I don't know how much construction costs, it sounds like it's pretty simple what you're building. But yeah, walk us through what those risks, if you, eyes wide open, you're walking into luxury self-storage or anything like that.
Yeah, I mean, we talk to the reasons we mitigate them, right? We try to work with higher end clientele. We're not trusting ourselves with people that are just shifting apartments and trying to pay $89 a month. So I think that's helped us. But there's risk associated with everything. I don't know, is the product type going to be needed for everywhere we build? We don't know. We're creating, right? That's the risk. You're creating a new product type that hasn't been offered in most markets. There's plenty of markets with flex space in it. There's some people that just won't touch it. They absolutely only do self-storage, and the highest, they can rent it out for the highest per square foot because there's 5x5 bays and all that. It's just a different business model. But then there's some people that won't touch self-storage anymore. That's just completely overbuilt in their eyes. And they need to find a source of some other, option. So there's some risk. I mean, these are very simple buildings for the most part. People can use them. People do use them. And like I said, building in poor demographic areas, was my biggest test. I didn't know that at the time. And I think that's how you come up with things, right? Like you shouldn't know everything when you start your first project. You as an LP, if you knew everything of how my asset class was going to go, I mean, as an LP, and most of the LPs I talk to, you need to trust, the jockey more than the horse. Like, you trust your operator before you're trusting just the basic statistics or data on a real estate deal and showing you IRRs. Trust the operator that he's going to make the right decisions. Try to overcome hurdles. There's hurdles every day. Every quarter I rant about on a 3-minute video, to the investors of like, here's the stuff we're working on, marketing more for stabilization and leasing it, there's always something where it can be better. And I'm always a guy who is always trying to improve. So I think that's where LPs can trust an operator. It's like, find a guy that's innovative, find a guy that, or a person, a gal, whatever, someone you trust that knows that like, even if the product type's not perfect, we're pushing this as hard as we can to try to make the success happen of it. So, because not everybody, it's not like we have a 20-year track record. I mean, you can go to invest in a REIT and go for a 5.5% dividend. I get it. Go do that, And if I didn't send you your 5.5% in year 3 because we just didn't make it, it's not that the valuation has been hurt. It just took longer to stabilize than we anticipated. I'm like an open book to most of my LPs, and most of this burns me more than it burns them. And so I think transparency from an operator is super important. And as an LP, look for that. You can't hear fluff and butterflies all day. There's always problems. And I could tell you about my concrete company. I could tell you about my construction company. I could tell you about my property management company. I'll talk to you as transparently as possible. I love business and running things, but if there's no problems, I just don't know. I want that business.
Yeah. Can you share a little bit more about, I think this is a trend I would like to spearhead of the transparency train and driving, highlighting great operators that do, great monthly or quarterly reporting, or that are, just present a lot of the information up front in data rooms or anything like that. Can you talk a little bit about maybe how you approach communicating with your investors, what you include, all of that kind of stuff?
Yeah, no, that's an awesome question, because it's, I invest with you. Now what happens, right? And that's a very common question we have. So if you're, for our process in the Mac Capital, you come and invest one of our deals. Everything is through a portal, of course. That's how we manage K1s and taxes. And basically our entire documentation lives in that portal. Distributions are wirelessly sent. We do everything on a quarterly basis. I wanted to try to get to monthly. I still might get there at some point, but realize it's not a huge upside to that. It's a lot more work. I need to staff it more, which then I'm going to have to charge people more. I can very much give you on a quarterly basis a video update of how construction's going. Maybe we're in the middle of construction. I can share with you a job site link that shows a live feed to the job site so you can check it yourself. And so those are some of the things. We were doing monthly construction reports to them. We kind of get it from our construction team and share it with our investors as we're building. But that link has provided a lot of security for them. They're like, yeah, this is fun to watch. And I'm in Pittsburgh, not in South Dakota. So it's nice to see how this is going, and I can check in anytime. But very much on a quarterly basis, we talk about the income. We always talk about the problems. Income expenses is always part of the deal. But if you're in the stabilization process, what are you doing to market? How can we be better? And I have a page on there, always on our template, and it's a 4 or 5 page. I try to keep the video to a minimum, like 10 minutes, but it's a video update of how the property's doing, what we can be better at. And that's usually where the meat and potatoes is. Like my portfolio manager, it's like, how do we be better? And he knows as well as I know. It's like, yeah, we need more leasing agents, or we need to have people stop living in the units, because that's starting to be a problem, or why is there a tenant with a pool outside and has their kids in there on the weekends? That's not okay. So, you're always constantly adjusting your lease and trying to be more, again, property management issues. It's a long story of all sorts of different issues, but I always love to tell my investors those stories. They always appreciate them, whether they laugh about them. It costed us money, so I had to boot them out. And trying to, yeah, I think it's just transparency. It goes back to, but quarterly reporting is just fine. And we found all our investors on a monthly basis. I used to update them, and I almost pester them more than there was a lot getting done. So on a quarterly basis, kind of gives you a little more of a show. We can do our distributions at that same moment. You get your report. It's just laid out in an email, basically what happened. There's a video link, and you can watch it and watch us during construction. So it's, to us, we think we've found a sweet spot within, doing our asset management correctly.
Yeah. And I think highlighting those stories or the funny things actually important. I get those on maybe like half of the investments I'm in. And I think what they really do is they just make the investment real, right? I think it's easy as an LP to invest money in a deal. You saw the investment summary and you're like, okay, well, this isn't going to plan, or this isn't, this isn't exactly what the plan was. And, it's still a business that you're investing in. So I think that kind of transparency is great, and would love to make that the gold standard. So thanks for pushing it on there.
Yeah. And I just to add, I mean, so we do development, we do the construction, we do the management, we do the asset management. It's all one team. I think it's just one head to chop. It's mine, basically, is what I try to tell people and investors. I'm always telling my investors about that. But, another powerful thing about social media, because I'm all about culture at all my companies, all my investors end up turning out people like me because they know who I am on social media. They know what I'm about. They know what I'm doing day to day. They end up being, really good investors. I think one of my worst investors are all my first investors because they just didn't understand what I was doing and who I am. And I was kind of taking money without, really vetting them because of course you need in your first deals, you're trying to get something made and build your track record. Well, it's just another, really good touch on social media is your culture building. Even if I have new employees come to my construction, they know who I am. They know what I'm about, they know what I'm doing. And it just seems to be a really positive effect for me as I raise money from LPs. So I think you and I have to get along as an LP. Otherwise, I don't want you in there. I don't like you. I ain't taking your $500,000. I don't care. You put 2 million in front of me. I don't care. You're just going to be a problem to me. And I'm going to be a problem to you. So it's like, let's just not, we don't need a date. We don't need,
Yeah.
I don't
Yeah.
need to. Yeah. So it's another important piece though, as an LP, got to find someone you do like and really enjoy as an operator for you.
Yeah, I hear that. Marc, where can people go join your investor list, learn more about you, follow you?
Yeah. Most of the largest place people find me is on LinkedIn. You can get to our email, maccapitalgf.com. I think we're redoing the website right now, so hopefully that's back up by the time this airs. But if not, you can find me. You can find me on LinkedIn. DM would be one of our investors. Basically, we jump on a call, and again, we vet each other. If we like each other, I'm not going to push you. I don't push anyone into a deal. I more or less vet and then give them the opportunity to invest in a deal. So, great place to find me. LinkedIn, Marc Kuhn.
Love it. Love it. Okay, amazing. Thank you so much for sharing with us today, Marc. For those of you listening, if you're ready to deepen your understanding of passive investing and explore other unique opportunities like this one to grow your portfolio, be sure to join us next Thursday and every Thursday for more actionable insights on the Passive Income Playbook here on the Best Ever CRE Show. If you enjoyed this episode, please subscribe and leave us a review. Your feedback helps us continue to deliver valuable content and reach more investors like you. Thank you for tuning in, and I'll see you next week for another episode of the Passive Income Playbook.